Welcome back to the channel of Data Financially Follow. As I cover things, sometimes it's educational, sometimes it's highlight things and whatnot. And I've been doing these monthly casino updates. And there's one thing to really kind of annotate over here is going to be the tax drag and what's going to be the tax impact of all this. So not going over the casino, but going over what happened in 2025. And granted, this number over here, I did start this one in 2024. So, this one shows a little bit higher number and we'll kind of go into that later. But ultimately, 99% of all of this was received inside tax year 2025. So if you think about, $68,000 in dividends, that could be a pretty hefty amount of taxes to go pay on that, especially if you think, oh my God, you paid on $68,000 of dividends over here, and then you realize the loss over here is $69,000. I mean, what world does that make sense? Because those losses aren't going to offset the ordinary dividends that come through here. And by no means are any of these qualified dividends either. But there is one tax advantage it did have into this, is return of capital, ROC. So it was lowering my cost basis, which also lowers my, my overall loss in this thing. But it also means I'm not paying taxes on this. And because I'm using margin, part of these were received back as substitute income payments. And all that means is that, hey, someone else was using options on my securities. And when it paid out a dividend, it should have come over to me, but it doesn't recognize it in the same way as like return of capital will show up. So it shows a substitute income. And I was having to reconcile a lot of that too. And then because of the way that these investments are set up, there's also income from US government securities. So then there's an additional tax benefit in there as well. So it was really relatively very convoluted, to say the least, to figure this out on my tax return. So first things first, substitute payment information. There's a couple which I was trying to find, I wasn't able to pull it up in the historical data, but I was trying to do my best as they were announcing that, hey, what is going to happen with each one of these distributions? If I had a substitute income come in, how much was going to be return of capital? And then, how much was going to, based on that, how much of that was going to be a non-dividend distribution. And for these, I use my average ROC to kind of ascertain, what's my best foot forward on that. And then as the press releases that were coming out on it, where it's talking about, I'm just going to show one real quick. It would let me know like, hey, FYI, Ulti over here, this one had 100% return of capital. So if I actually had a substitute income payment based off of Ulti being taken out on someone's option, and I know it's 100% was, return of capital. Or here was Coney over here at 96.77%. So I had to go through and I was collecting this just for my own due diligence in case the IRS ever comes back and questions, how I'm coming up with things. I have all the press releases. So going back to this, that's how I was able to figure out on my substitute income, what could I be able to discount from it? And there was two different accounts I was kind of rocking here with. But for the main one over here, I don't want to do average. Of the substitute income, I was $3,800. But because of the return of capital component, I was able to, reduce that even further. So instead of, paying ordinary income tax rates on that 38, I was able to reduce it because I was doing my due diligence and keeping track of, the return of capital that was coming through. It was only going to be $663. But this is something I was actively aware of, and I'm not trying to put this together come tax time. Just like, hey, as these things are coming in, let's just log it and be proactive on it. Then another thing was there's income from US government obligations. This is also going to be helpful, not for the federal, but from the state side. So seeing how much on these individual investments, how much came through on it, and then how much is directly attributed to US government debt. And then that gave me a further deduction for the state side. So I just had to keep track of this stuff. Luckily for me, Yield Max was very beneficial because they do provide this. Now, this stuff does come late. This is not going to come in January, February, or March. We're talking April. Man, they drag their feet. But, I was keeping track of all the dividends that came through. And that way, when it came tax time and they actually released this, I'm able to figure out what the inputs are going to be to make sure that this is done accurately and correctly. But, also I'm saving this for my records in case there's ever an audit. I'm, hey, this is how I'm coming up with these numbers. Everything over here is, verifiable. Now, coming back over to here, you can see like, hey, that's 68,000. But, not all of that's going to be taxable. So as I mentioned, there's a couple different accounts I was kind of rocking with over here. Let's go into this one. And the corrected, man, it came out with the corrected really late too. But they're trying to reconcile and deal with that return of capital component. So that way you're not getting taxed on 68. So of that, you can see that, hey, I ended up having to pay taxes on this $12,000 worth of the dividends. But there was another side of this as almost $44,000 that I didn't have to deal with because that was for non-dividend distributions, return of capital. So then I'm only dealing with this side over here, which makes, life a hell of a lot easier. And then when I exited my position, it's not like I got to go realize, a $69,000 loss. Once again, dealing with different kind of portfolios over here, running different kind of strategies. Not all my accounts are listed, but this is great loss harvesting to kind of help offsets. But I wasn't able to get the full 66. So you'll kind of note that as well over here. Because that return of capital lowers my cost basis in the portfolio. So yes, I didn't have to go pay taxes on this 43,000, but when I went to go sell, it lowered my cost basis. So my overall loss was slightly diminished, which I still had enough loss to offset the capital gains I was harvesting at the same time. So it worked out in the end, but this kind of just highlights some of the high level, tax planning strategy I was trying to implement in here with the loss harvesting, gain harvesting, as well as being proactive in logging what's coming in on. If you're doing margin, you're going to deal with the substitute income payment and making sure that you're not paying taxes on the full amount, because if there's a return of capital, you need to be making sure that you're tracking what's happening on that return of capital. Better to do this throughout the year than to not do it and then come tax time, hey, congratulations. Let's say if I'm at a 30% between federal and state tax bracket on that $3,000, I just paid an extra $1,000 in taxes on this. And don't be surprised if you need to hold off from your filing because you're doing some of this stuff, that these corrected 1099Bs are going to come. And ultimately it's going to probably help you because it's going to lower the actual ordinary dividends while increasing our non-dividend distributions for the return of capital. If you're anxious and gung-ho on filing, all right, I get it. Just be prepared to file an amended return later on in life. That's all it comes down to. Or if you're a little bit more patient and you don't mind waiting, then just kind of hold off. They'll get to it eventually. And if it gets closer to the deadline, either one, file the return. If there's going to eventually be one, you'll just amend later on. Or number two, file an extension. If you have a balance due, pay what you owe. That way you don't get dinged for a failure to pay penalty, because an extension is only a failure to file penalty mitigation strategy. It does not do anything about if you have a balance due. So pay what you think you're going to owe based on the 1099B. Once they get the corrected one, it's obviously going to lower out, and then you'll get a refund for the remainder. This is only if you owe. If you have a refund, then obviously it's not that big of a deal to go ahead and go on extension, which once again, not that big of a deal because you have an extension in place. And number two, if you have a refund and you go on extension, the IRS really is not going to bother you. They're more than happy to collect interest on your money and not pay you. But yeah, that was overall, the tax impact that I saw from implementing this strategy, from all the dividends that were received to, not getting the full realized loss, but, not having to pay the full taxes on this amount. So I hope you found that this being insightful into, why it's prudent to take steps during a tax year, documenting things that are happening inside these particular investments, because it can save you money in taxes. So if you found this information useful, feel free, like, subscribe, leave a comment, and stay tuned to our next installment. Thank you and have a great day.